Welcome to the lecture on income tax analysis. So, in this lecture we are going to do the tax analysis, after tax cash flows, effect of income tax on after tax cash flows and other things which are basically the result of the income tax you pay or the income tax which is paid by the corporation and resultant effect of that on the cash flow of the organization. Now, as we know, the taxes are basically levied by the government, assessed as a function of gross revenue minus allowable deductions. So, basically the gross revenue is there or gross income is there for any organization or for an individual. On that we have to pay the tax, but then there are certain allowable deductions and also personal exemptions for individuals for many causes. So, once you subtract these deductions and exemptions from the gross revenue, then you get a part which need to be taxed. Now, on that the tax rates will be there, and depending upon the amount you earn, you will have to pay certain percentage of that known as the tax rate. So, for individuals or for the companies, these tax rates are decided by the government. The tax rates may be governed by the rules of the center or by the state as far as the country tax is concerned. For our own country like India, different types of taxes are there, like property tax, sales tax, excise tax, all these taxes. So, once we have the income, on that we have to give the income tax. So, income tax basically will be dependent upon the gross income of individual or the net income of the organization, but these taxes like property tax, sales tax or excise tax, they are not dependent upon the gross income. They are basically related to certain type of transactions in that sales, or if you have any property, if you, and this is excise tax for some non necessary items. So, you have different types of taxes, and these taxes are basically not dependent on the gross income, whereas the income tax is dependent upon the gross income. Why this tax study is important? So far we have studied about the effect of interest, the cash flows, replacements and other things, but in that basically we study before tax studies. Now, once you pay the tax, the cash flows are changing. Now, this change is not very large, not very significant, that is why we do the studies before tax, but we cannot ignore the effect of tax. Once you pay the tax, once the tax is levied, it affects the cash flow, and anyway it has certain effect on the cash flow. So, this is important to study the after tax cash flows, because once the company pays the tax, how the cash flows are changed, we need to see it, how much the company gains or how much the company loses, this has to be studied. Now, after tax cash flow will be based on MARR. Basically, after tax there will be MARR, attractive rate of return, minimum value, and there will be basically the before tax MARR. So, basically the amount which you pay or the effective interest rate on which you pay, basically that governs what will be the after tax MARR. Taxable income of individuals has to be calculated by deducting personal exemptions and allowable deductions from individual's gross income. So, as we discussed, if the person has a gross income, then there are personal exemptions and also the allowable deductions. So, these are basically subtracted from the gross income and then you get the taxable income. On that taxable income basically you have to pay the taxes. For business venture, net income or loss is calculated for each financial year. So, basically in the case of business venture you have the income, on that basically the deductions or the expenditure in carrying out the operations, all these are the deductions, they are to be deducted and then you get the net income, and on that basically you are, once you deduct these expenditures then you get the taxable income, and corporates or business ventures are also taxed at certain rates. So, let us see how the income tax calculation is done. So, we have to see how these income tax calculations are done for companies and for individuals. So, let us see, if we talk about our own country, then in the year 2015-16, let us suppose the rule is like this. If we have taxable income, so what we see is, for the normal group of persons, I mean excluded are the categories of either female members or the senior citizens, but in normal case suppose it is written that up to 2,50,000 there is no tax. Then from 2,50,000 1 to 5 lakh there will be 10% of the amount above 2,50,000. Then from 5 lakh 1, so more than 5 lakh to 10 lakh you have 20% of amount above 5 lakh. So, what comes here is basically you get 25,000 here. So, you will have 25,000 plus, and in that you will be adding 25,000, because this 25,000 comes from here. So, up to 5 lakh, if you take 10% of that, it will be 25,000 plus the exceeding amount from 5 lakh to 10 lakh, whatever is exceeded, its 20% is there as the tax amount. If the income is more than 10 lakhs, in that case the amount will be up to 5 lakh. You have 25,000 plus you have in this 5 lakh 20%, that is 1 lakh. So, it will be 1,25,000 plus you get amount exceeding 10 lakhs. So, this is how you compute the income tax amount, and if you go, this is up to 1 crore, and then if it is more than 1 crore, in that case it is 30%. So, 10 lakhs. So, this is basically 30% of this amount, 30% of amount exceeding 10 lakhs. Here if it is more than 1 crore, you get 30% plus surcharge is there. Surcharge is basically 12% of income tax amount paid. Now, on all that, basically by the government regulations you also paid other tax, like in our case we also pay educational cess of 3%. Then there are other kind of taxes. So, there are taxes which are included in this. So, they are known as different taxes. They all come to finally the total amount is paid as taxes. Now, for corporations basically we have in India we have up to 10 crores, you have 30%, and then more than 10 crores you have, and also surcharge is there. Similarly, here also you have different surcharges there. So, basically these rates vary from time to time. It is not that it is fixed, but what we need to know is that we should be aware about certain terminologies, how the income tax is calculated and how it has bearing on the economic analysis. Example, let us say that you have an income of suppose 7,50,000. This is your taxable income. In that case, your tax amount will be so you are in this category. So, in that case you will be 2,50,000 to 25,000 plus it is amount exceeding 5 lakh is 2,50,000 and it is 20%. So, it will be something like 25,000 plus 50,000. So, it is 75,000. So, this is how you calculate the taxes. Now, on this amount further you have to add certain cess. So, that may come to some percentage of 75,000 and then you get the values and total tax is computed. So, this is how the tax amount is computed. Now, let us say we will try to know something about the effective income tax rate. So, what is effective income tax rate? This effective income tax rate, it is one particular percentage of the tax rate which when multiplied with the income, it basically directly gives the amount paid by the individual or by the organization. So, in that case let us see a person is having the income of taxable income of let us say 12 lakh. Now, in that case, the amount which he will be paying will be it will be up to 2,50,000 nil, from up to 5 lakh he is paying 25,000, then up to 10 lakh he is paying 1 lakh, plus for the extra 2 lakh he is paying 30%, so 60,000. So, altogether he is paying 1,85,000. Now, let us take the example, his earlier salary was suppose 9 lakh. Earlier he had taxable income as 9 lakh. Now, in the 9 lakh, basically he was paying the tax as 25,000 for up to 5 lakh plus 20% of the amount exceeding 5 lakh, that is 9 lakh minus 5 lakh, so 4 lakh. So, he is basically giving 1,05,000. Now, what we see is on additional or incremental income of rupees 3 lakhs, the person is paying, we see that he is paying 80,000 extra, rupees 80,000 as tax. So, what we see is for the incremental income of 3 lakh he is paying rupees 80,000. So, basically that is known as effective tax rate. In that case, for the income of 3 lakh from his present base of income of 9 lakh, for the another 3 lakh income he has to pay 80,000. So, effective tax rate will be 80,000 divided by 3 lakh. So, basically it will be 26.67 percentage. So, this 26.67 percentage is known as the effective tax rate. So, in fact, this is not the actual amount of tax what he is paying, he will further be paying some cess, some educational cess and other things, but ignoring that, if we calculate the taxes for knowing the effective interest rate concept, we can come to this conclusion that the effective interest rate, effective tax rate paid by the person for this 3 lakh additional income will be 26.67%. So, basically in future whenever we will talk about the tax rates, we will talk in terms of effective tax rate, because we will assume that he comes into a particular category and for any additional income he has to pay that many percentage of the tax. Now, this effective tax rate basically is important also to get the after tax MARR, in the way that after tax minimum attractive rate of return, that is MARR, you can take it as 1 minus effective tax rate into before tax MARR. So, basically before tax MARR is there, and this effective interest tax rate, this will be basically subtracted from 1, multiplied, it will be some approximately giving the after tax MARR. Now, we have to study something about the effect of interest earned and its effect on tax rates. What happens that many a times we used to invest the money in the bonds. Now, in that case, when we invest them in bonds, some of them pay us the interest annually and we have to pay the tax on those interest, whereas in some of the corporation bonds or municipal bonds, maybe we are exempted from paying the taxes, and in that case basically you are getting the return somewhat lesser. So, we have to see that how this interest affects the after tax cash flow. So, let us see, we can have an example where suppose a person has purchased a bond. Now, he has two alternatives, has to purchase a bond. So, he has two alternatives, that he can purchase from a company and he can purchase from the government authorized agency. So, what happens that the condition is that if he is investing rupees 2 lakh on the bond, and this company will be paying him 12% annually, and maturity is 7 years. In this case, the thing is that it is paying 9% annually and tax exempted. So, in this case, now in this case it is his income. So, here also it is investing 2 lakh. Now, if you look at the cash flow diagram for these cases, what you see is that in this case the cash flow diagram goes like this. It has paid 2 lakhs now, and every year it is getting 12% of this. So, 12% is 24,000. But at the end of 7th year, basically it will get 2 lakh plus 24,000. Now, in every year it is being paid 24,000. Now, the person is coming has to pay %29 effective tax rate. So, he is coming under that category where the effective tax rate to be paid is 29% on any additional income. So, basically what happens, if he is earning 24,000, he has to pay 29% of this as tax. So, it will be basically 29% of this amount, and that will be basically 6960. So, 6960 every year it has to pay as taxes. Now, what we see is, although he has the income of 24,000, but he is paying 6960 because this is an income to him. He has got this bond from the company, and ultimately effectively what he is getting is 24,000 minus 6960, that we will see later. Now, let us see for the government authorized agency. Here again it has the 7 years maturity, same. So, in this case the cash flow diagram will be like this. It is 2 lakhs on the negative side and 18,000 it will be getting. It is getting only 1, 2, 3, 4, 5, 6 and 7. So, in the 7th year it will get 2,18,000, but during other years it will be getting 18,000 here. Now, what you see is that here basically the company is earning the interest rate. If you look at how much it is paying, the actual amount which the company is getting is 24,000 minus 6960. So, this will be 17,040, and here it is getting 18,000. So, basically it will be 8.52% and this is on 9%. So, effectively if you look at the interest earned or the benefit which is the company is earning, in this case it is coming as 8.52%, it is coming as 9%. So, this is how the purchasing of the bond from the two agencies having different conditions, they affect the cash flow and they affect the effective tax rate, I mean earned by the person or the company, and this must be taken into account while calculating or while deciding which of the option is better. Thank you.